All right, today we're going to put Molina Healthcare, ticker MOH, right under the microscope. This stock is caught in a serious technical tug of war, with some powerful forces pulling it in two completely different directions. After some really wild price swings, it's now at a critical crossroads, and we're going to break down exactly what that means. So let's set the scene here. Back on October 7th, 2025, Molina stock hit its peak, trading at just under $207 a share. That's the high watermark, right? The peak we got to keep in mind. But then, just a few weeks later, on November 20th, the bottom completely fell out. The stock plummeted down to its 52-week low of $133.40. I mean, that is a huge drop in a really short amount of time. And that, right there, sets the stage for the whole conflict we're looking at. So, yeah, that's the big question, isn't it? After a plunge that sharp, what happens next? Does the stock just keep on falling, or is it kind of like a coiled spring just ready to bounce back? That's what we're digging into today. All right, first up, let's look at the argument for the bears. The case that says this stock's troubles are far from over. And when you zoom out and look at the long-term trend, well, it tells a pretty clear story. Okay, so the report's overall momentum score, wow. This is a real eye-opener. This thing is calculated from more than 120 different indicators, and the result? A staggering negative 333.64. The official rating? Strongly bearish. I mean, this is a huge top-level sign that the stock's underlying energy is just pointed firmly down. And when you dig into the details, the evidence just keeps piling up. The price is trading way below its long-term moving averages, and you can think of those as the stock's average price over the long haul. The trend strength indicator is super high, which confirms this isn't just some temporary dip. No, this is a strong downtrend. And a bunch of other indicators, they're all pointing to some heavy selling pressure. It's a really compelling case for the bears, for sure.
So, yeah, to put it simply, the big picture, the long-term trend is pointing firmly down. From this angle, the bears are absolutely in control.
But hey, that's only half the story, right? Because while that long-term picture looks pretty grim, the short-term data is telling a completely different tale. So let's flip the coin and look at the case for a potential rebound. Okay, before we dive into the signals, we gotta talk about this key concept, oversold. The best way to think about it is like a rubber band. When a stock falls way too far, way too fast, it gets stretched out. And this oversold condition, well, it suggests that that rubber band might be stretched to its absolute limit, and it's just ready to snap back, even if it's only for a little while. And this is exactly where the bull case gets its strength. A bunch of key indicators are flashing oversold, just like that stretched rubber band we were talking about. The price has actually managed to claw its way back above its very short-term moving averages, which is a small but really significant sign of life. And another key momentum indicator, the MACD, has turned positive, kind of hinting that some bullish momentum might be quietly building under the surface. And this really gets to the heart of the whole conflict. See, depending on the time frame you're looking at, you get two completely different stories. The long-term view, it's all weakness. The short-term view, you're starting to see a little flicker of strength. The report itself sums it up perfectly. It says, this divergence highlights short-term strength amid broader weakness. It's a textbook case, a classic tug-of-war. So what do, right? You've got this powerful downtrend clashing with a potential short-term bounce. How does the analysis make sense of all this and come to a final verdict? So how do we actually know who's winning this fight? Well, the analysis points us to two super critical price levels. You can think of them as the lines in the sand, the battlegrounds, and how the stock acts around these levels, that's going to tell us if the bulls or the bears are taking control. Okay, the first critical level is the floor, 133.40. That's the 52-week low we saw earlier. For the bulls to have any chance at all, they have to defend this line. If the price breaks below this in a big way, it's pretty much game over. It signals the bears have won, and the downtrend is probably going to keep going. And on the flip side, you've got the ceiling, 145.64. This is the first major wall of resistance. For the bulls to prove that this rebound is for real, that it has legs, they need to smash through this price. A solid move above this level would be a huge sign of strength. So, you put all that together, what's the final verdict? Well, this table lays it all out beautifully. The outlook is basically neutral in the very short term. It acknowledges, hey, a bounce could happen from these oversold levels. But, and this is a big but, because those long-term signals are so incredibly powerful, the outlook remains bearish for the medium and long haul. And that leaves us with the million-dollar question, doesn't it? You've got this powerful, established downtrend. Think of it as the heavyweight champion. And it's being challenged by this scrappy, short-term rebound. In this technical tug of war for Molina Healthcare, which side is going to win? The charts are going to be watching those key levels very, very closely for the answer.